Gresham College presents Long Finance Spring Conference 2012, Part 4, How to Incentivise Sustainable Finance, a panel discussion.
Well, thank you very, very, very much for the taking the graveyard slot there, Matthew, and giving us, I think, a challenge, really. We probably should have called your talk "Investing as if investing mattered," I think. It's a
fair point.
That's really what it's about. I'm on the record as remarking about a number of schemes that they look like Baroque finance, because by the time you've seen the World Bank doing their thing, and it's underwritten by this and that, and then Moody's and Standard & Poor's are going to rate it, PwC and E&Y are going to audit it, and then we're going to have some environmental auditors in and all that. You say, well, where's the money at the end of all this? And people say to you, oh, that's the best bit. You don't get it. We're going to reinvest it in green. And I say, well, that's called a donation and not an investment. So well done you for pointing out we really need to get it back on track. One of the things I also was reminded of as you were talking was this paradox. And tonight we have the Sustainable City Awards, in which the 117 London Accord reports from last year were all entered. One of the semi-finalists was James Leeton's Carbon Tracker report, which arguably, to some degree, started with the London Accord when we asked the question, what happens if you burn it all? So if you take all the stuff that's on people's balance sheets, what happens if you burn it? And just to give you a little flavor for it, we're currently just short of 400 parts per million. The scientists say 500 is pretty bad, 550 is certain death, and the rough numbers were something like 600 parts per million if you burn the oil, about 900 if you burn the coal, ignoring brown coal, by the way, and something like 1,200 if you throw tar sands in from Canada. So you know, you're exceeding your targets. Well done. But at that time, we weren't even looking, as James and his team did, at shale gas. It's pretty terrifying. And yet all these things are on the balance sheets of companies at roughly $100 a barrel at the moment, which is kind of weird, because it assumes I'm going to be able to burn before you. So we'll all be able to burn first. And then you have to ask, well, if that's also true, then why are there exploration companies? I mean, I'll give it to you if you think you can bring it forward faster or cheaper, but you shouldn't be drilling in 20,000 feet of water off South America or Africa. So interesting problems there that you raise.
Just as a point of order, Mr. Chairman, we Canadians prefer to call them the oil sands. Tar sands apparently has a bit of a negative connotation to it.
My apologies. I never was a good diplomat. Anyway, we've got a great panel here to face off against the first one. That's no pressure, folks. And what you'll notice here is we've got Joss Tantram from Terrafinity, who has some very interesting thoughts which were out there on valuing natural capital in a perfect world. And then you'll see here that Sarge has been replaced by Valéry Lucas-Leclin. And so if you look at the CV, it's pretty much the same CV. So just read Sarge's CV and say it's Valéry. Sarge, unfortunately, was called away at short notice today, and Valéry has very kindly come and stepped in. But they do work as a close team, so I think we will get some of Sarge's insight, but much improved, and with a much nicer accent. So if I could, just to get things going, Joss, would you mind opening up with kind of the thoughts that Matthew struck in your mind in his presentation?
Yeah, thank you, Michael. I am live. Yes, I'm just going to give throw a few concepts at you. I would categorise what I'm going to say as a wildly optimistic set of perspectives. This is coming not from a finance expert or a economist, but I suppose I categorise myself as a humanist ecologist, someone who's interested in capable citizens and functioning ecosystems. Just to cover a few things that I'd like to cover is the future that's coming. I'm going to pick up a little bit on what Matthew talked about, but try and do that with some sense of hope. I also want to throw a few concepts at you that we believe are useful in terms of valuing the future as more important than today. Some of the challenges that we have in terms of the financial system and the way that economics works. And to also suggest three aspects or three things, three provocative suggestions on how to re-engineer the concept of price. I've also been terribly frightened as we've been talking about, there's been a number of quotes on the importance of understanding our place in history. And I've been sweating on hoping that no one mentions the one that I've got, which is a separate one. Now, this is from Terry Pratchett, the well-known fantasy author. And his quote is, "If you don't know where you've come from, you don't know where you are. If you don't know where you are, you don't know where you're going. If you don't know where you're going, you are probably going wrong." And I think that's an important one for us to bear in mind. So what is the future that's coming? Well, we know, as Matthew was saying, that 9 billion people are coming. We know that 9 billion people is going to change the dynamics of the world that we live in. We are already, in terms of serving the purposes of the advanced world, running into resource challenges, running into the challenges of water availability, of price availability, of the volatility of those key resources. We're also starting to see that certain resources like rare metals are going to present pinch points to the technology ambitions that we have over the next few years. And when I'm talking about the next few years, I'm talking about the next 40 years, in the run up to 2050, where we're going to have 9+ billion people. Also, as Matthew mentioned, the current system gives rise to unintended and unpriced consequences, which threaten the functioning of the system, as we have already. So that's the negative side. On the plus side, we are, as a species, incredibly capable of conceptualizing and achieving great things, of moving mountains, feeding populations, greening deserts, and making leaps of imagination and innovation. We're also, and most of you are in this room who are very adept at this, adept at financial and mathematical wizardry, using fantastically complex and clever models to assess and assign value. And really the challenge that I think we have is for value to be more based upon capable citizens and functioning ecosystems than it is at present. Now, if we think about that world of 9 billion people, it's worth thinking about those 9 billion people being capable citizens. Now, we believe that understanding those people or aspiring to having 9 billion capable citizens is a useful way of thinking about a positive vision of the future. If those people are capable, we mean economically capable, capable of making economic plans. Those people would need to be well educated, have access to ICT, capable of making decisions over the medium and long term for themselves and their families. We believe that in order to do that, the prerequisites are that we need industrial systems that are based upon harnessing and enhancing natural capital, and also upon preserving natural ecosystems and using abundant and renewable resources. So that presents some challenges. And the challenges are that we need to start moving away from scarcity as being a fundamental motivator or a derivative for price, and we need to start to move towards other ways of defining price and connecting value, real value, i.e. functioning ecosystems and capable citizens, to the price that we pay for things. Now, I'm going to conclude with the 3 concepts that I believe are important to what I would say re-engineer the concept of price. Now, Michael was saying, do you really want to suggest these to this audience? And I said, well, they're not bulletproof, but they are interesting. And what I'm trying to do is throw out things that might make you think. As I said, I'm not an economist or a finance professional. I can't defend these to the ends of the earth. However, I think 3 concepts to place at the heart of price, which would produce more innately sustainable outcomes, are that if we valued abundance rather than scarcity. For a world of 9 billion capable citizens, scarce things are only of marginal utility. Either natural abundance or managed abundance, i.e. the use of circular systems, we believe is inherently more valuable over the long term. We believe that cultivating natural vitality, i.e. basing our industrial systems upon natural productivity and learning from the way that natural systems manufacture, is innately more sustainable. And we also believe that in the social dimension we should value interdependence. Nothing happens in our modern world without the actions of others, and we depend upon others for our quality of life. We believe that we should value the quality of life of those people we depend upon as importantly as we value our own. And I believe that those 3 concepts are of interest if we want to achieve a sustainable world.
Thank you, Josh. Valéry, your thoughts on perhaps in particular, kind of, strategic SAI, taking the long term.
SAI, yeah, sure. Thanks very much again for accepting me as a replacement to Sarge. Sarge and I have been colleagues now for more than 12 years, and we are both co-head of SRI research at Bank of America Merrill Lynch, so I'm very happy to be with you this afternoon. My day-to-day work, as you can imagine, is just, the traditional work on the financial floors, not the trading floors, but the research floor. So every day we publish research, news flow, things like that. Right this morning we published a new additional 275-page on climate change. Thanks very much for that. So yeah, and again, it's about climate change, it's about energy efficiency. It's the third time that we address the energy efficiency issue in the brokerage world, and I must confess that so far, we always receive a polite welcome by your colleagues or sales colleagues, especially saying, well, nice report, big report, interesting report, off-the-shelf report, fundamental report, but now how are we going to sell those ideas? And it's always the same, with sustainable finance. There's a kind of discrepancy between short-term horizon and long-term horizon. When you always come up with the same names, in a report like Schneider Electric or Siemens or why not Tesla Motors or BMW, you always come up more or less with the same names on such mega trend. At the end, people say, well, we know that, but we think it's already priced by the market, so why should we buy it now? Well, there is still a very big mega trend for the next 25 years. We think they are still doing quite well, so why not right now, because the stocks are undervalued, why not should you do that? It's very difficult to convince them. And my experience, my very personal view now on that is, when I see the title of this roundtable, it's what could incentivize sustainable finance. Honestly, I see 2 carrots and 1 stick. The first carrot, that's one we have been looking for years with Matthew, is financial outperformance. If you can demonstrate at the end of the day, thanks to different tools, that you can deliver quite systematically some sort of financial outperformance, well, thing is done. You've just proved your case. Then you will benefit from a huge appetite from other investors. So a lot of us have been trying to find out these sources of financial outperformance. It's very difficult, honestly, for different reasons. But there is a second carrot, very, very important. Maybe you're not very familiar here in the UK, but it could play a role elsewhere in Europe, which is simply the tax incentive. Just to let you know, right now, it's been now 12 months that we have been different discussions with, for instance, the French Ministry of Finance. The guys would like to help long-term finance. They don't know exactly how. They have different options, and we try to promote or to sell the idea that maybe if we could come up with a kind of standard definition of what an SRI fund is, what an SRI fund should deliver, not in terms of financial performance, but in terms of ESG value. You could, if you can demonstrate that maybe your SRI fund delivers a better carbon footprint or delivers a better social footprint measured through employment or wages or better wages, things like that. If you could demonstrate that in an objective manner, not just using scoring, but really demonstrating that your fund is committed to that and can deliver on that, those guys are ready to consider a tax incentive. Because then you play a positive role towards society. You play a positive role towards, first, the government. You play the role of, actually, the government. It's not going to be very well received by Milton Friedman, but anyway.
It's okay, he's dead.
Yeah, I think, fortunately for me, for sure. So, that could be the other incentive. Because at one point, it's very nice to talk about sustainability, it's very nice to talk about many things, but we have to deliver, and we have to measure what we deliver. Right now, basically, honestly, I don't know if we will share my mind, Matthew, Josh, but we have not been able to measure any kind of ESG output. We have an SRI fund, we run an SRI fund, we give some research, but at the end, what does it change? Better footprint? Worse footprint? Commitment to that? No, for the moment, nobody really knows that. There have been some attempts, but it's still very limited. So definitely, when you talk about incentive, for me, it's tax incentive. If we could demonstrate that we can deliver something, then I'm quite positive that some governments will follow up. Just to make you laugh, maybe in 2006, I told you just before, but in 2006, during a pre-TV campaign meeting on the French television, a former socialist candidate named Dominique Strauss-Kahn said that he wanted to see the SRI funds growing up to 25% of the French assets under management. So those guys, those politicians are aware of SRI funds. But for the moment, they do not know exactly how to use that. Are they friends? Are they foes? Can they rely on that? Can they have some leverage on that? They do not know yet. And maybe the last thing, because I know that my time is limited, maybe I would say the stick. Again, if we can measure what different funds, not only the SRI funds, but the other funds, the traditional mainstream funds, can deliver in terms of ESG output, then it could be a reputational stick. If you can measure the output of all the funds invested in UK companies and demonstrate that some funds have really a poor track record in terms of ESG, maybe those end-of-use clients, those asset owners, will feel a little bit uncomfortable with investing their money into this kind of fund. So yeah, that's what I had in mind, and after hearing Matthew on sustainable finance.
Matthew, you want to talk about something?
I'd just like to respond a little bit to what Valéry said, and full disclosure, many years ago, when Valéry was still in his early teens, we worked together. I'd like to think that I'm sort of a paler, inferior version of his thought process. So I think we would agree on almost all of these, if not all of these issues. The trick, and I neglected to mention this in my earlier remarks, I mean, the good news, back to Mr. Strauss-Kahn, who I guess has other preoccupations these days, but when he sets the 25% bar, Valéry will be well aware of some credible, but I don't think it's correct, research that says by 2015, there'll be 20 trillion managed along these general lines. $20 trillion, which is what? About that would hit his target. The good news is that the UN Principles for Responsible Investment have now got 30 trillion. At current rate, they will have 300% of all assets in the world being invested sustainably. The bad news, as I said publicly at a United Nations Environment Program Finance Conference in the last couple of months, if there's anybody out there who believes the UNPRI's self-assessment that 80% of that money is currently being invested integrating environmental, social, governance factors with traditional financial ones. That's the conclusion that the PRI had about itself, that 80% of it is being used. I said, look, if there's anybody out there who thinks that 80 is a better number than 1%, which would be my very generous back-of-the-envelope calculation. I'd like to see you after the conference and discuss some real estate that I have for sale in Florida. So the question is, how can we turn... I used to think when I was younger that hollow, pious, empty rhetoric was a bad thing. But in my dotage, I've decided it's actually a very good thing. At least it's better than nothing. Because once a major figure with some ability to do something has nailed their colors to the mast, then the accountability clock starts to tick. So I guess the question I would ask my friend and colleague is, and I think that's a very good start to a recipe, is there anything else that we can do as individuals to hasten the day when that 1% gets to 10%? And when research like the stuff that you put out, like the stuff that Nick Robbins puts out at another bank, not to be named, to make sure that it's actually not just weighed or commented upon, it's actually taken seriously throughout the organization. How do we get there? Sorry, not to put you on the spot.
Well, don't take it personally. Not him, you. But usually, I'm perceived as very pessimistic about SRI. I've been working in that field for 15 years now, so I'm not pessimistic. I'm just a bit skeptical. Realistic, maybe. Honestly, I've been working 2 SRI rating agencies, 3 brokers now. I'm not absolutely sure that the financial world is the right one, to find, I would say, altruistic people, Can
I quote you on that?
No, you can't. But no, honestly, it's, here people are here to make money and rather make it in the short term than in the long term. So, for me, behavioral finance is really something which matters. At the end, it's really a matter of behavior, your beliefs. And I don't think that in the markets, as far as I know them, with my very limited knowledge again, but I don't think that it's well perceived to be altruistic. I think people prefer the tough guy, simply like that. It's better to be the tough guy. It's better, and you know that as well, and probably you as well also, that people prefer to be wrong with all the others than to be right alone.
Yep.
Take the risk to be right alone. So it's always better, to be the wolf amongst the wolves, saying that sustainability doesn't bring anything or doesn't bring anything in the long term.
Well, the interesting thing, if I could just quickly come back and take that explicitly to the long-term investing question. I mean, again, it's not that there is, you talked about evidence. The evidence, if anybody cares to look at it, is unmistakably clear. Whether you want to talk about Jeremy Siegel at the Wharton School or Joel Greenblatt, one of the most successful active equity managers ever, the record's pretty clear. If you hang in and invest for the long term, you will outperform. There's no, I mean, the evidence is there, I would suggest to you. What's missing is the political will to hang in and do that. And I was arguing that if you can somehow summon that will organizationally, if you can somehow, as a trustee of a pension fund, not fire your manager after 2 down quarters, to be replaced by somebody who is guaranteed to outperform the guy who was fired. I mean, we know that too. The statistics are very clear. So we know what to do intellectually. It's a question of behavior. Behavioral finance rules.
Well, we've just heard quite a few dualities, fear, greed, cost versus investment, abundance, scarcity, carrots and sticks, long and short. Audience, over to you. What are panelists saying that strikes you as good or bad? And I'd like to get some faces down there at the back in particular who haven't had a shot. So if you're at the back and think I'm not looking, this is your opportunity. Hands up back there. All right, then the front wins by 2 votes. Steve, and we're a bit short of time, so do make them quick, please.
Isn't the real issue that we have an externality called absentee ownership? And we've had fiduciary duty as being co-opted. Essentially fiduciary duty is all about not acting against the broader interest of the stakeholders, and everyone has taken it to mean purely financial, but it isn't purely financial. So I would suggest that there's another stick that we're not using, and that is the law and fiduciary duty, and also education of our asset owners, that we need behavior modifiers. If they were calling for it, and if they were demanding on the analysts, and they were demanding of the company directors to take into account our sustainability risks, then these, the language you're going to hear, Valéry, is very, very different. People are going to be desperate, to look at this. So that behavior modifiers will.
Okay. So fiduciary responsibility. A gentleman back there on the aisle.
Yes, thanks, Alejandro Litovsky. It seems to me that despite the evidence, and people are talking about the evidence again and again, the rational argument doesn't fully make it. And so what I would like to hear from the panel is, do you think there is a role for the sort of the Islamic finance movement, the religious-based sort of financial institutions, that might take a more proactive role in terms of how values could be mainstream in all of this? What is your thinking?
Okay, we'll come back to Montana in a minute. Andrew Ross.
I'd like to connect with the previous session with the idea of property values here. What we're seeing globally is a gigantic land grab going on, both with the mining industry and with the agribusiness industry. And the players here are sovereign funds. It's Korea, it's Saudi Arabia, it's Qatar, it's China, investing in Africa, in Brazil, and elsewhere on huge scales. Now, this isn't noted through the share price valuation of London Stock Exchange companies. It's huge funds moving in on a colossal level to outsource their food supplies and their mineral and energy requirements. How do we bring property values into that on an environmental level?
Thank you. And last comment, just up here, Steph.
David Hales, Open University. I was just reading Hayek again on the way down, and there his idea is the market as an information aggregation system that allows for the right information to be given to the local actors at the right time. It seems like what's been said here is that in some respect that seems to be broken in this case. And also some of the comments almost suggested there's a kind of commons dilemma situation going on here. I wondered if the panel are aware of kind of the recent work of Elinor Ostrom in the way that decentralized behavioral kinds of solutions can be found to some of these common pool resource dilemmas, and whether you think that maybe in some way that could be brought in. Can a market mechanism be produced that's modified in some way to communicate more dimensions of information to maybe incorporate some of your aspirations?
Actually, I think that's a very interesting and positive point. In fact, we asked Eleanor if she'd like to come at one point. For those of you unfamiliar with her work, Elinor Ostrom studied, she took things differently. She said, everybody talks about the tragedy of the commons. Let's see where it works well. And she dug out a whole heap of systems in Japan, the huertas and irrigation systems in Bali, where she pointed out that systems like these actually do persist over a long period of time. And she set out 7 core principles. So I would commend those to you. I think that's a very good question. Joss, let's break up these 2 long-lost lovers. You know, what's on your mind?
Let's break up the reunion. Well, I was going to pick up on a couple of things. The commons dilemma, and this going back into the depths of my personal history. My anthropology teacher was very keen to deconstruct the tragedy of the commons, to show all the positive examples of where common ownership actually did produce good outcomes. I mean, one of the concepts that we're toying with is the idea of common self-interest. Now, it's not just deliberately shoving opposites together, but it seems to me in the long term that it's manifestly in the interests of private enterprise to have functioning businesses over the long term and to have a citizenry that is capable of making choices that could choose their products and services. There is a shift required manifestly to go from private short-term self-interest towards private long-term self-interest. But to me, private interest and common interest should be pretty indistinguishable over the long term if we are interested, if we had a common intent towards a planet where 9 billion people were capable of buying the things that we want to sell them. There is also another interesting quote from Paul Hawken, who's a great writer in sustainability, and he says there are noble fortunes to be made from sustainability. To my mind, it is private innovation, private interest, etc., which is going to drive, or should drive, a positive future. We don't have a fantastic track record at bureaucracies delivering good outcomes. When it comes down to the individual level, people tend to suffer, and we've seen that in many parts of the world. So I believe that somehow what we need to do, and it speaks to this issue, it is about saying how do we take away the short-term incentives to extract money, and how do we start to drive long-term private interest in aggregating money.
Valéry, I'm just kind of curious. I'd like to pick up some of the questions here. Fiduciary responsibility. You provide these lovely reports explaining to people why they should do things. What happens?
What happens, actually, they are always well received by the SRI teams we have at nearly all the major accounts, asset managers, I mean. So I would say that for the moment, the SRI sell-side analysts talk to the SRI buy-side analysts, which is fine, which is a good starting point. But if we want to go a bit further, we need to make sure that we can also talk to the other guys, also asset managers. And reversely, we should make sure that the buy-side analysts have access to our financial colleagues. That's what we try to promote here at Bank of America Merrill Lynch. Sometimes we receive requests from our direct colleagues, and we just say, okay, guys, I'm not the expert. I cannot know everything about every stock. Just call and talk to the real estate guy or the auto guy, whatever. So we try to promote this kind of dialogue. It's going to take a lot of time. It will work if at the end all our colleagues can see that there is a quite strong commission fee flows from those clients just for this kind of answers. And at the end, it's always money-driven. It's not only money-driven, it's money-driven and regulatory-driven. And that drives me back to the other question, the role of Islamic finance, for instance. I agree with you. We can see the SRI or sustainable finance as a sort of fragmented market. There are places for different niche or approaches or different, we can play it in different ways. I used to think that finance looks a little bit like different, aggregated circles. What I am most interested in is finding the key to the core circle, the retail finance. Of course, I absolutely welcome, microfinance, any kind of religious-driven finance. That's fine, but it's always in the margins. And again, being inside the machine, I can tell you that all those, I would call that again, maybe not the most appropriate word, but marginal circles of finance, is not going to convince people. People are just going to say, well, I have to do it because it's religiously driven or because it's microfinance. It sounds great. I find it looks great on the report and things like that. The key thing is, do we have a chance to convince the core circle? That's what we try to do. That needs education, that needs tons of good reports, and that requires total time. And sometimes we'll be able to find some materiality. Honestly, we are not that many, to promote materiality, to find out materiality.
I'd be happy to talk to the fiduciary question and the sovereign fund question over coffee later or over something stronger. But I'd be remiss if I didn't point out, I think, something that is at the heart of what Valéry's talking about, and that is, and something I spent a bit of time on in my book, and that is something, again, that this group will be very familiar with, the old double standard. I mean, and Valéry's quite right. People, show me the proof, show me the evidence. The people who are asking the questions, if they ask those questions of themselves, I mean, for example, would it surprise anybody that the last time I looked, the Wall Street Journal does this wonderful public service, being a philanthropic organization. They do scorecards, league tables on the different investment banks. And the question, very simple, what percentage of the time are you correct? And when by correct, I don't mean guessing Exxon's quarterly earnings within 2 cents. It's up or down. Company X, January 1, a year from now, is its stock going to be up or down? The top rated investment bank in the world, the last year I saw those statistics, was wrong, directionally wrong, not just a little bit wrong, directionally wrong, 8+ times out of 10. 8. So you're telling me that people like me are kind of a little wacky and not very rigorous and don't have a solid body of evidence to support what we're doing. If what you're doing is any indication, your track record, I mean, I couldn't possibly do worse than your track record. Flipping a coin, hiring a monkey to throw darts. So my plea would be, can we have the same standards applied across the board, not just set the bar for this kind of stuff 6,000 times higher?
I agree. But again, it's always the same story. Better being wrong with the others than being taking the risk to be right alone. So, yep.
We don't have a lot of time for this panel, sadly, because I think it could go. And I think we've shied away twice now from the land issues, but we'll pick those up, I suspect. But I am curious about one thing for all of you. I mean, we're trying to invest for the future. One of the things that particularly bothers me is that most of this has been founded on government policy calls. And a lot of those reports that you claim are wrong were founded on if these Green New Deals do this, if biofuels is that, if the EU ETS. I mean, I'll pick out a particular London Accord member, Deutsche Bank, who are constantly writing reports, very good ones on the ETS, but when government policy fails to materialize, the report is invalid. So how important is it to have consistent policies to make this stuff happen, or can it happen without? Because you talk about strategically aware investing, and I can tell you for a fact, I go in and talk to pension funds. I have no problems with two very basic long-term themes: population growth, resource scarcity. They get it. There's no question with that. They have no problems with it over the very long term. The question they have is, why, if that's so true, and even the numbers supporting that have been true over the past 20, 30 years, why is it, on the other hand, I consistently lose money investing against those two themes? And I think that's a heck of a challenge. So, Charles, any quick thoughts?
Well, I was going to say, I mean, initially, because there's still plenty of money to be made by being unsustainable, for the reasons that I've discussed in terms of the challenges of putting sustainability at the heart of price and value. So that's an issue, and it's always well worth remembering that the biggest companies in the world, very many of them don't really take these things that seriously. It doesn't matter because we still need lots of oil, etc. So we have economies that are based on things that are unsustainable. From a personal perspective, in terms of regulation, is that I've given up hoping for leadership from bureaucrats and legislators, mostly because they are, well, there's a couple of reasons. They might be captured. They tend to look for leadership from business or investors, and it just seems to chase its tail. I don't believe we are going to get leading guidance, regulation, taxation, anything from regulators.
Valéry, a concluding comment on that question?
Yeah, for sure. We have published so many reports on different sustainability themes, and, well, sometimes it happened, sometimes not. Yeah, at the end, you know, as analysts, we do some kind of forecast. So we just built up some scenarios, and we just say that we stick to the scenario, we are optimistic or not optimistic. Sustainability is a cost also. You know, it's an investment, but as any investment, at the beginning, it's a cost. So the same question is always rising. You know, when is it going to pay back? It's always the same issue, and sometimes, you know, we just have to wait 10 years or 15 years. Governments, can they wait right now in the current circumstances? Can they wait 10 years, 15 years? I very much doubt of it. So it's not a big surprise to see so many investment waves, sustainable investment waves, just, you know, clashing like bubbles. Yeah, we had wind, we had first biofuels, then wind, solar now. Who is now positive on all those industries? Not all negative, but very positive. It's very difficult, just because it costs too much right now.
I guess I'd say, Michael, that here's a definitive answer for you. It depends. I mean, some markets, like the one you're talking about, the carbon market, is a policy market. Full stop. End of story. Clean tech is hugely driven by policy, granted. But there's a lot of industries, most of the others, where public policy, I think, and regulation are, I guess the first point I make is they're secondary to the competitive. They're not primary drivers of the market the way they are in carbon markets or clean tech markets. But what gives me, I mean, Joss was striking an optimistic note, and just in case anybody thinks I'm going to go out and commit suicide after drinks, not before, I'm actually an optimist, and the reason I'm an optimist, believe it, I'm maybe in wolf's clothing, is that the kinds of things that we've all been talking about are fundamentally not policy-driven at all. They're secular megatrends. And I don't care what, big picture, 40,000 feet, I don't care what governments do, the population's still growing. We're not making any new fresh water. We're not, it would appear that we're not making huge progress on income inequality, et cetera, et cetera, et cetera. Those are structural drivers that, regardless of policy, will continue with increasing force to affect and reshape and redefine the competitive environment of companies. And so I'm betting on the megatrends, but as Valéry would point out, I need to stay alive long enough for those megatrends to manifest themselves. And if you have a bad week, you hope that your investor client doesn't fire you. But I certainly take your point on the fiduciary thing, and just quickly that a lot of stuff was cut out when I moved down from 10 hours to 10 minutes, and one of the things that had to be cut out was your point about fiduciary responsibility, and my plea to one important thing that we should look to do, and you mentioned trustee education and so on. I'd love to see the investment food chain restored to the way God intended it, where the owners of the asset were the top of the chain, not at the bottom. And so theoretically, the trustees responsible for pension funds, etc., they're the ones that make the policy decisions, and we poor bankers and fund managers are we're simply executing their will. But the thing has got to be restored to its natural order. It's become totally perverted, in my humble view.
Yeah, capitalism as if ownership mattered. Yes.
Yeah.
Well, folks, sadly, we have to break time-wise here. As you know, the idea of the London Accord and long finance is really to get a discussion going, and so there will be appropriate discussion materials to imbibe, which will aid you in your talk. I think it was very interesting today. My mother was always a fan of that lovely poet, very profound poet, Ogden Nash. Many of you will know his deeper philosophical works, but he once had a poem I was taught as a child. Some debts are fun when you are acquiring them, but none are fun when you are retiring them. And I think Matthew was pointing out in his talk that that's really the case here. We've got to turn these from debts to opportunities, and somehow we've got to achieve that. Josh on let's see what we can do about valuing abundance, and Valéry, who I think is a realist, pointing out to us that finance has a role, but we've got a lot of other work to do. So I'm going to say a few words in a minute to close down, but I'd like you, if you wouldn't mind, congratulating our second panel on such a great discussion. Thank you. Well, as you know, at any conference, it's obligatory that the so-called chairman has to stand up and close down. Unlike Matthew, I've taken his 9 hours remaining for my summary. So we will be closing down sometime around 3 in the morning Tokyo time. No, quite seriously, there's some feedback forms on your desk, chairs. So go start filling those out while I close down. We're far more interested in what you thought about the day than what I'm about to say. But I will go through a few things about what's happening in long finance. So do fill out the feedback forms, and the team would like to take them. The first thing I'd like to point out is that we have 4 programs going. Today is very much based around long finance, but also the London Accord. And I would encourage you to go to the website and look at some of these investment research reports that we're talking about. Some 48 firms have donated. It's now up to about 270 reports on the website. So the one I mentioned on unburnable carbon, responsible fish in Asia, the lovely report by Bank Saracen saying sustainability has a correlation with sovereign debt performance. And of course, all of the reports of our sponsor, BAML, and that big bank that sponsored us in the autumn that begins with H and ends in C. So lots of good reports up there if you really want to get your teeth into this. And that's in many ways why we run long finance events more as discussions on the assumption that you'll go out and read them. The second thing that I'd like to point out is there are a lot of other long finance publications coming out of the core of long finance. Probably the most interesting one recently was one called In Safe Hands, which came out at the end of January, which looks at scenario planning as applied to the future of financial services. I think, to borrow Josh's phrase, it may not be bulletproof, but it is interesting. So do please have a go and a look at those reports there as well. One of the things I'd like to also do is just point out there's a lot of other events coming up in the future. We have, under the Financial Center Futures program, the Global Financial Centers Index 11 will be coming out next month, and we're also looking at changes in the asset management landscape globally. And there's a report that many of us are struggling with, but I hope it comes out this year because it should be fascinating, uses and abuses of discount rates. If you really want to get your teeth into the tools that people use to evaluate the long term, I think we have to have a good look at that. There are a number of other events listed there. I'll pick out that we have one next week at Barnard's Inn Hall, just up the road, home of Gresham College, where Victoria Chick, who's quite a famous professor and also extremely well known for her work on Keynes, is going to be talking about Gresham's law in economics and how that helps us analyze or not analyze the crisis. A truly long-term view of history will be the Roman denarius and the euro, a precedent for monetary union. I'm looking forward to that. And we have a longer-term event with Baroness Deach looking at regulating the regulators. So there's a lot of things coming up, not least of which will be, of course, the Long Finance Autumn Conference. We are probably going to be hosting that with UCL, and it is probably going to be taking a particularly interesting view at social notions of value and happiness, and have we got anything to learn from that? Again, all of this is online on the community, as you'd expect, so please go ahead and have a look at that. Just before we close, one of the things that I find particularly interesting is this whole notion of folly and value. Robert Mundell, when he was accepting the Nobel Prize for Economics in 1999, said, "The main thing we miss today is universal money, a standard of value, the link between the past and the future, and the cement linking remote parts of the human race to one another. The absence of gold as an intrinsic part of our monetary system today makes our century, the one that has just passed, unique in several thousand years." Now, he was not, and I certainly am not, harking back to the gold era, but I think what we are struggling with in this financial crisis discussion in the first panel on alternative currencies, Josh talking about abundance versus scarcity, and the questions from the audience on things like land, I think we are struggling to figure out how do we tie our value system to our monetary system and in turn to our financial system. So those would be my words from today. I have a few thanks to give as well, and you can thank them as well when you hand the evaluation forms, hint, hint, over to the staff. But first I'd like to thank the team at Gresham, Dawn, Scott, James, Lauren, and Barbara, for all their help and assistance, and this will be up on the website. I'd particularly like to pick out James Franklin this time because you will have seen, many of you, in City AM today, that Charles was able to actually have a very nice précis of what he spoke about today, so we are sharing that. I'd like to thank the team at Zien for all their work, Chiara van Gunten, Stephanie Rochford, Geraldine Mullins, and Linda Cook. You don't notice it, hopefully, but they're the people who make all of this work. And then finally, we must thank with sincere and warm hearts our hosts, Bank of America Merrill Lynch, and in particular, Kagan Lovely and Maureen Murphy, who really put a lot of work into today and have kindly donated this facility, and more importantly, the discussion equipment you'll be about to use in a moment to us. So thanks to all of them. If you don't mind, could we join hands on that?
For more information, please visit www.gresham.ac.uk.